Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Looking at the markets, I can't even tell you that hope you're doing well. So finally, the Reserve Bank of India has realized that inflation isn't transitionary and there is a serious problem. After all, to announce an unscheduled rate hike, that too of a 40 basis points repo rate hike and a 50 basis point CRR, which is the cash reserve ratio hike, is quite a thing. Last week, even the US Federal Reserve increased its rate by 50 basis points as expected. Now, while the stock market and the bond markets in India were factoring in a 50 basis points hike by the United States Fed, the sudden hike by the RBI rattled the markets as it was an out-of-syllabus event. The above events clearly indicate how serious the problem of inflation is. In my view, the question is not whether we have an inflation problem or not, but the question is how sticky this inflation is going to be. Also, from a stock market perspective, the question is how much of this inflation effect is priced in. While the Nasdaq kept on hitting 52-week low every time, India has relatively outperformed despite the crazy FII selling. Now, if I would have told you that in FY22, FIIs sold a cumulative 3 lakh crore of equities, and on the basis of this information, if you had to judge what the Nifty level would be or where the Nifty would have fallen, I am sure most of you would have guessed at least 20 to 30% decline. In 2008, this much selling resulted in the stock markets crashing by 60%. However, this time we have the retailers who are directly and indirectly investing in equities through SIP. 11,000 crores of SIP has been invested in Indian equities. So, the billion-dollar question is, how do we position our portfolio on the basis of this stock market crash? While I personally believe there could be more downside to the markets in general, what is important is to position your portfolio which will relatively outperform the benchmark indices. A lot of people tell me, if you feel there is a downside, why not keep cash? Yes, that is definitely a good option, but keeping cash is a short-term solution. After all, in the end, if you want to beat inflation and create alpha, you must be invested in equities for the long term. Also, the perils of keeping high levels of cash in anticipation of a crash is that you don't know when the bottom will be made. After all, market tops and bottoms are made in hindsight. Re-entering is extremely difficult once you sell your shares. You know, there are two sets of people who can sell at the top and buy at the bottom. One is God and others are liars. Trust me, you and I cannot and should not even try to do that. Also, to take advantage of the falling market, an investor can keep 20 to 30% cash. However, in my view, staying invested in equities for the long term is a short way of beating inflation. So, now I'm sure you must be thinking, what is this guy giving us so much mutual fund type of a gyan? ठीक है, let's straight get to the actionable ideas. Also, please do note that keeping a diversified portfolio with debt and gold is extremely important, especially at such high valuations. So, let me tell you about the stocks which you should look at in your equity portfolio if you expect the markets to correct. Now, my first stock is ITC. Now, you must be thinking, is this guy out of his mind? When inflation is expected to go up, he is recommending buying a FMCG kind of a stock? Hear me out. Cigarettes, which account for 40% of revenues, contribute to 85% of profit before tax. ITC brands of cigarettes have a 80% market share in India. So, if you think logically, have you ever heard inflation taking a toll on cigarettes and the demand for them? Also, when tax rates go up every year, There has never been any demand hit and the company can pass on the hikes to the customer without any problem. A person who smokes is addicted to it, and therefore this segment for ITC is inflation proof. So basically what I am saying is 85% of your portfolio before tax is kind of semi-inflation proof. Now the other important business for ITC, which is the FMCG business which the company is trying to scale and establish a strong position, is a bet on diversification. FMCG business, which has biscuits and snacks, accounts for 25 to 27% of revenues but contributes only to 6% of profit before tax. That is the problem point if we look only from the numbers perspective. However, you do have to understand that ITC was a late entrant and it takes time and money to build brands. Now that the company has achieved a meaningful scale, the efficiency ratios like return on capital employed and return on equity in the FMCG business will drastically improve, which till now was a drag on the consolidated ITC business. I am not discussing other businesses like hotels, paper and packaging, as they are relatively small and are doing fairly okay. However, in my view, hotels, which account for 4% of the company revenues, is expected to turn corner and generate good profit. So the most important question is that after all of this, why does ITC trade only at 18 to 20 times price to earnings multiple? Why is it that the market is not giving it a higher multiple for such good financial business and strong balance sheet? Most important reason was that the cash flows generated from the cigarette business were being used to fund to build the FMCG brands. This resulted in poor capital allocation for the company. This also dragged the consolidated ROC for the company. However, things are changing and the FMCG business is generating strong cash flows by itself. Also, one more reason why the stock underperformed for so many years is that globally, with the whole ESG theme gaining traction, FIIs were reluctant in investing in cigarette company. That is evident from the fact that FII stake started coming down in the company. So now my point is very simple. You put your money in a fixed deposit, it gives you 5% post-tax return. ITC has a dividend yield of 4.5 to 5%. And trust me, in any given year, it will give you at least 8 to 10% capital appreciation. So, you get a 12 to 15% return from ITC when all these high beta stocks in your portfolio will keep on crashing as the markets fall. Let's take the worst case scenario and assume that the markets keep on crashing and ITC will still outperform the broad market. I mean, at 18 to 20 times price to earnings, what do you even have to lose? My advice is ITC is a screaming buy every time it falls. The risk-reward ratio is extremely favorable. In this market, if ITC say corrects by 10 to 15% temporarily, trust me, it is a blessing to accumulate. Just buy ITC blindly. You will be in awe of the return it gives you over the next 2 years along with the massive dividends as cash flow to you. So that was about ITC. Now the next stock which I am looking at is Hdfc Bank, the big daddy of the banking industry. I am sure we all know what happened to the HDFC twins post the merger news. The run-up was unwarranted and thus the stock price reverted to mean. While I am not a banking expert, so let me evaluate HDFC Bank logically in terms of the valuation comfort which I can see. Also, as interest rates go up, big banks like HDFC Bank and ICICI Bank are much well positioned to capitalize on it as they have a much better CASA ratio, which means the proportion of current accounts are much more than savings accounts, leading to lower interest outgo when interest rates rise. Now let's talk about the price action. Just for your reference, while majority of the stocks are still above the pre-COVID levels, HDFC Bank is one of the few stocks which has massively underperformed the market and the banking index. Let's talk about price to book value, which is the parameter used to evaluate banks. HDFC Bank 10-year median price to book is at 4.13, while currently it is trading at a price to book of 3.1 times. Also, if you look at the price movement, the 5-year CAGR return of the stock price is a negative 2.5%. So, you are telling me the country's best bank has given no returns for 5 years. In fact, it has lost money for its shareholders. The point I am trying to make is that valuation risk reward is in your favor, as the downside will be relatively capped. Say the worst case scenario, markets continue to drop as we are assuming. HDFC Bank will be much less impacted as the downside is protected. Obviously, the caveat is that HDFC Bank will never give you the delta or the superior returns. However, it will protect your capital in this downturn. So friends, these were the two stocks which I believe will hurt less when the markets go down. Basically, the aim is to relatively outperform when there is carnage in the market. Thank you for watching my video. Hope it adds value, and please do write to me in case you have any queries.